Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week on the podcast, it's a chance to have a return conversation with Jim Strang, who is the chairman of HgCapital Trust, the private equity listed investment trust, and also an advisor to a number of private equity firms, and also teaches private equity at London Business School. So a man who is worth visiting in terms of trying to get a panoptic view of what's going on in the investment trust world, and also, of course, to talk about what's been happening at HgCapital Trust, which remains, despite slightly more disappointing performance recently, one of the best performing investment trusts in the entire universe over the longer term. So let's start, if I may, Jim, with talking about the private equity market overall. We know that has been very gummed up in the last few years. A number of challenges, realizations have fallen, and the ability to fund new funding has therefore fallen accordingly, and so on. And this cycle has been, well, it's been caused by a lot of things, but it has certainly persisted for some time. So are we near the end of that process, and how would you assess the situation of the private equity industry generally at this point?
Yeah, sure. Well, thanks for having me back on. It's a pleasure. I would say it's a bit like a Scottish New Year. Okay, so 2021 was Hogmanay, and boy, did we have a party. And depending how you played Hogmanay, you either had one drink too many or you woke up under the table. And I would say where we are now is about the 4th of Jan. So the initial shock of the morning after has kind of passed. We're definitely feeling better, but maybe not feeling great. And exactly how well you're feeling is a bit of a function of how big a party you had. So the overall messaging, I think, is that certainly we've gone through the dip and we're somewhere out on the other side, but it has become a kind of a bifurcated world of winner and loser. And if you're on the right side of that, then you're operating in a new environment, but that's okay because we're used to that. But if you're on the wrong side of it, then you're finding it very difficult, and difficult around your portfolio is having a harder time performing. Your ability to raise capital is diminished, and indeed your overall sort of private equity cycle of sending money back has been disrupted, and all of these things that make it pretty difficult. In a nutshell, that's kind of where we are.
And what difference has the arrival of Donald Trump in the White House made in that process? Obviously, we've seen some very volatile markets, certainly the start of the year. First and second quarters went in opposite directions, and a lot of uncertainty has spread in business leadership as a result of the policies that he's been pursuing. What specifically would you say about the impact that he's had and the policies the administration is pursuing on the private equity cycle? Has it improved things or made them harder to navigate?
Well, I mean, the uncertainty is not great for anything, is it, really? And I think the change of government in the US definitely threw in a decent amount of uncertainty. And that does create some challenges because effectively in private equity, you're being asked to underwrite something like a 5-year business transformation, if you had to sort of make it simplistic. And that's hard at the best of times. And when you throw in a bunch of uncertainty, it makes it doubly hard. And it means that, like, who can operate in that world is you really better know what you're trying to achieve and have some sense of how you can navigate through the uncertainty, because it's not going to go away. But clearly everyone's in a different camp on that. And to the extent you're able to lean on what you know and your capability and your experience to go through it, then you can manage it easier. But if you don't have that and you're trying to just play what's right in front of you very tactically, then that's hard. And what you saw in the first quarter of the year was a big disruption to deal markets because the initial shock was really significant, as everybody knows. But what's happened, I guess, interestingly, post the summer, it's actually really busy. So, I mean, the people that I work with one firm who do a lot of work on advising on the transactions, which is our Bain & Company, and Bain is really, really busy. So, I mean, there's a lot trying to happen. Let's see. So that's a good sign. But certainly the uncertainty shock at the beginning of the year was everybody felt it. And it was a question of how hard you felt it and how quickly you could get past it.
And one of the sort of side effects of that uncertainty, combined with other fundamental factors, is that we've seen the significant pressure on bond markets and higher interest rates. We thought they were coming down this year. That hasn't really happened. In fact, long bond yields have been pretty strong, to be honest, and that's having an impact on the cost of debt. So is that a factor too in the general equation that one would be thinking about as far as private equity is concerned?
So I would say the cost of capital, the cost of leverage is it becomes an issue if you've started in one place and you ended up somewhere else. So if you have a really big shift in the cost of debt, to the extent that it really is a major shift question, but if it is a major shift, then where it becomes a problem is if you're asking or you're going to ask the next owner to refinance their transaction at a different cost of capital to the one that you bought it at. And that is where things can get harder. And what happens generally in that kind of environment is things take longer. So if you look back to the GFC, what happened in the GFC where we had sort of similarly disruptive times, the number of transactions that failed was actually really relatively low. But the one thing that did happen was duration extended, because effectively, like I tell my students at LBS, the beauty of private equities is the only asset class in the world where the insiders make the liquidity decisions. So effectively what you're saying is, as long as we can stay in control, and that's a big topic, and that is the kryptonite of private equity, is you must stay in control. Because if you can, you've got this one-time option to pick your moment of exit. And now it might have been 4 years at a 2% interest rate. Well, if it's a 4% interest rate, it's going to be 6 years or 7 years. But eventually you can solve it with the passing of time. And that's the impact, right? So that's the impact for the transition investments. But for the new investments today, it's like, well, the world's moved, so we re-underwrite things at a higher level of interest rate. And what that generally does, just mathematically, is it changes the maths on the entry pricing. So the pricing of assets comes down. And this is what bungs up the system, because there's a sort of a pipeline of assets that are trying to sell or would like to sell. But the prices that their owners would like to achieve for them are a function of the capital structures that were created at the time they were required, and they are different now. So if you bought something at 15 times cash flows, if you run the math forward, then actually equilibrium pricing for that now is maybe 12 times. And 3 turns of multiple compression is basically horrid to value creation, because the only way you can get out from under that is you have to have a really materially different level of EBITDA. And again, the way you do that, if you can stay in control and you know what you're doing, it takes time. And so every multiple point compression costs you a year. So if you have 3 points of multiple compression, then you're going to have to own it 3 years longer, unless you can do something very, very clever. And that's where we are.
Right. So people are having to own these things longer than they expected to and longer than they perhaps would like to do. So that's having an impact, as you say, right across the system. And higher interest costs don't help that process by reducing the discount rates and so on. But in the meantime, though, I mean, 2 years ago, we were all worrying about the fact that private equity valuations weren't coming down as fast as listed equity valuations were coming down. Now we've had 2 years of actually pretty strong listed public equity markets. In fact, all-time highs in a number of cases. So is that a countervailing thing working in your favor when you come to value your portfolios, or is it actually insufficient to offset the impact of the other things that we've been talking about?
So I would say, I mean, with HGT, as we've said in our documents in the last couple of reporting cycles, we've felt more negative pressure than positive pressure. And I think the reasons for that is that, I guess, the value of public markets more broadly, as you know, it's concentrated in certain areas. And if those areas have done what they've done, but other areas maybe haven't done so well, or indeed have gone down the way, not up the way. And so the way we value the portfolio, the HGT portfolio, for example, there are 55 assets in the portfolio. Everyone is bottom up valued, and the metrics are some level of profitability and then some applicable multiple. And the applicable multiple is a function of public market comparables, which are relevant to the underlying company. So things like SAP is very relevant, but NVIDIA is not, because it's just a totally different business. So it wouldn't be in the basket. And then the M&A comps. And this is all put together in a sort of a geometric sum. And the geometric sum is the trading comparables, which is a basket, and then the M&A comparables, which is also a basket. And everything is weighted and checked by the auditors. And it gives us one number for each asset, which gets us to enterprise value. And then we just adjust for the leverage and adjust for the ownership, and it gets to the respective share that we have as an equity owner. And that's the way the maths works. And again, obviously, in that, there's a massive dampening effect, because we've only got a portion of the actual value driven by the public markets. And within the public markets, only a relevant part of the public markets impacts the basket. And that depends on what we're buying. Or, you would have to look for something that was comparable. So it's not like a straight read across in any way. And indeed, as we've in HG have mentioned in their manager commentary, it's a big damped sine curve effectively against what happens in the public market. And that's what we feel.
Well, as you know, I had to ask this question. I guess there's been quite a lot of skepticism about valuations in private equity, and you've just explained some of the reasons why that might be. So as you're the guy responsible for the valuations, can you put your hand on heart and say that they are reasonable at the moment? Obviously, there's a wide range around it, which is what you're saying. So you're the guys who shareholders rely on to get these numbers right. How would you address the issue of reliability of those valuations?
Yeah, for sure. And obviously, it's an inexact science. I'll give you an example. So we've just sold a business called G Treasury. We announced it a couple of weeks ago, and we sold it for 97% above the value we were carrying it at. And we thought we carried it at a pretty fair value following the whole process and everything that we do. And actually, when we have people look at our process, because the board's job is to be a bit paranoid on this, as you say. So we push the manager and we bring in external experts to say, like, what are we missing? What could we do different? What could we do better? And we try and integrate that to the extent that we can. And then we still get these things where we sell them 100% above where we're carrying them. And why is that? Well, because the difference between a public market and a private market clearly is a public market, the prices are set by everybody, and a private market, the price is set by one person. And that one person can be anywhere on the normal curve of how they see value. And in the case of G Treasury, they were somewhere in the right-hand tail. And that is the nature of what we do. So what we try and solve for is the middle of the curve as best we can. And indeed, when we value the portfolio in aggregate, whether we look at the value, we have 7 different metrics that we use. And one of our colleagues designed this thing, calls it the gridiron. So you put all the valuation metrics on a piece of paper and just see where they all come out and see where we feel like we are relative to those. And things that give us comfort. I mean, G Treasury is a sort of a slightly annoying exception that proves the rule. But what we try and make sure we track is when we do sell things, are we selling them above where we're holding them? So we try and mark them appropriately, and we look for evidence of when we do sell them, are we actually achieving a greater price than that last time we marked it? And the evidence of that is pretty robust over time. And indeed, it kind of should be, because we value assets off the last 12 months trading. But when you sell anything, you sell the next 12 months. That's the way the markets work. So if the business is growing, it should be going up the way. Or if it's not going up the way, something's a bit wrong. So there should be some kind of uplift, and that's what we see. And G Treasury is just a very extreme example of the buyer looks a couple of years ahead, effectively, to get to the number that they did. But for the most part, if we can hold that metric somewhere in the 10 to 20 would be great, I would say. More than 20 means someone's in the right-hand tail. And if it's less than that, then there's something else going on that means it's come out a lower number.
So if I could then just talk about the listed private equity sector, I think we discussed last time, we talked about its advantages and disadvantages as a vehicle. And you highlighted in particular the potential opportunity that it provides for smaller investors to get access to this asset class. But in terms of the discounts, which of course is always the subject that comes up when we talk about listed private equity, we've seen discounts have come in on a number of trusts over the last 12, 24 months, but they're still pretty wide across the listed private equity sector as a whole. Yours is obviously much narrower than most. It wasn't so long ago you were trading at a premium fairly regularly, but you're now, I think, somewhere around in the 8, 10, 11, 12% range, something like that. What are your thoughts about the overall position of the listed private equity sector in terms of discounts and where you sit in that spectrum?
So the discounts are obviously very front of mind for all boards, I would say. And I think the challenges of the sector are, obviously, there's at least one major challenge, which is the cost burden of the model is very extreme or very high relative to other alternatives. And I think that's an issue for many around the notion of what you pay to go on this journey. And that causes a problem with the buyer universe. I think if you sort of take it back, there's a sort of who are the customers? And one of the things we think about at HGT is like, who are the customers of today and who are the customers of tomorrow? And will they be the same people? And if they're not, then how do we make sure we're relevant to the future customer as well as the current one? Because the nature of who the buyers are, what motivates their decisions, where they're based, the things that they need to see, that's obviously evolved, right? So there's concentration of the buyer universe, there's much more focus on aggregate fee loading. And then there's also this sort of nervousness around, because I still don't think most people really know how this private equity model works, frankly. I mean, the things I read in the press and stories I hear just make me think they're dangerous because they're a little bit informed, but they don't really know. And that just creates uncertainty. And the combination of the uncertainty and the high fee loading and the challenges of the buyer universe and then where the marginal new customer comes from, multiply all these things together and you end up with the situation that you end up in. And I think the way HGT thinks about it is we absolutely focus on this. And the way that we think about it is, we've been fortunate because we're a single manager and therefore we're sort of closer to the action in every respect. We've got a better sense of how the NAV of the company is going to progress and where the outflows are, which gives us some advantages in the way we manage the balance sheet. but it doesn't mean we're immune. And the way that we think about it is on discount management, we have a process for this. And obviously, if you have a process, you don't tell anybody what it is, because then they'll start arbitraging against it. So we don't disclose what it is, but it's in place. It's got multiple triggers and multiple time points against different peers. And if we break the triggers, our broker phones the board up and says, you've broken the trigger. And the board processes, we've all got to meet. So we meet, or a subcommittee meets and decides what we're going to do about it. And obviously the choice is we can either acknowledge it, live with it, or we can do something about it and buy shares back. And we've done that in the past. So we've met several times and bought back once in the last few years. And that's how we think about it. But the flip side is every pound that we buy back shares with is £3 of future NAV. So that's the cost of it. And we're pretty certain on the £3 future NAV. And we don't have any real certainty over the impact of the marginal pounds impact today. Or rather, it could last a day. The impact could last a day, it could last a week, it could last a month. We don't know, but we do know what the consequences of the £1 less that's going into the platform is going to be over the compounding of time. And that's the way we think about it.
So I'm interested in what the assumptions are behind that and what you just said. I mean, who is the marginal investor for HgCapital Trust and how has that changed? Are you saying that wealth managers are less inclined to invest in it now because of the cost issues and so on? Or is it something else? What's happened as far as the marginal buyer is concerned?
Well, there's the obvious concentration in the UK wealth market. And the way that's forcing groups that are buying on behalf of large client bases, the Kilters of this world, for example, the way that they run their portfolios is changing and it's concentrating. And you see that in the investment trust sector more broadly, where the whole thing is consolidating because the smaller vehicles find it harder and harder to be relevant to these customers that have more of an imperative for scale. And that's been going, the wind's been going that way for a while, and I don't think it's stopping. So that is one question. And then I think the other thing about the listed private market structures is because they've got at least one layer of relatively chunky fees, and in some cases two, because if you're a fund of funds, then obviously that's the nature of what you have. That can be problematic because counterparties and people that run these businesses just don't like that. They don't like the fee loading, and that's fair. I mean, it's a choice. I would say you look at the net outcomes, not the gross ones, and the net outcomes have been really good. But if you do have an issue or you have some sort of blocker that means that you find the fee loading too extreme, then that's going to stop you being a buyer. And clearly for some, that's an issue.
So wouldn't it just logically follow that if you think that the demand is constrained, therefore you might want to reduce the supply of what you're offering, which is the shares in the trust?
Yeah, but then my point is, if we do that, then it solves a problem in the short term, but it has this massive long-term penalty. And the reason that I get to the pound and £3 is that's the long-term underwrite of the investments that we make. So we've compounded up the net asset value at about 15% for 20 years. And if you just do the maths on that, then that is that continuing. And that's what we underwrite. So we're not underwriting anything changing in the investment model because there's no sign that it is. And if you just believe that, then when we think about making commitments to the HG vehicles, which is what drives the NAV, then that's the underwriting assumption. And that's a conservative version of what's happened in the past. So we feel reasonably good about that. And that's where the maths comes from.
So the implication of that is, I'm not putting words in your mouth, but sort of implication is that you are prioritizing the long term over the short term on behalf of the shareholders. But you've still got a job to do of explaining to them why the discount may be going out because of the changing supply and demand dynamics.
Yeah, I think we're there to support the long-term success of the company, but we have to accept that, and as I said, it has happened where we've broken some of our own internal triggers, or we've triggered them, and we've acted to try and address that short-term issue. But our bias is the long-term, because we think, again, that's what we're meant to be doing, supporting the long-term best interest of the company. And that's the trade-off that we make. But we're just very aware of the costs of that, and indeed, those costs are quite material.
Indeed, they are. You are listening to our Moneymakers podcast. We are an independent research and publishing venture and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Well, let's talk about HgCapital Trust then and what it's actually been doing. It's fair to say, I think, that the kind of results you produced recently have been below the long-term averages. And the share price year to date, for example, is down by around 10%, I think. And some of the other listed private equity trusts have performed much better. So what's going on in your particular niche area? I mean, you specialize in software and automated business services, software providers. What's going on underlyingly to justify that market movement?
So I'd say the elephant in the room, or the main driver, has been the valuation comparables that we're using against the portfolio. So if you look at the underlying trading performance, it's basically the same, I would say, with maybe a little softer. But if you think we typically compound profitability at about 20% a year, we're probably, say, 2-3 points below that in terms of where we are currently, but that's still great. So we're not too bothered about the impact of where the underlying trading performance is coming out. Is pretty much what it's been. The thing that we have seen, though, is we've had definite headwinds on the trading comp baskets. The combination of the public comparables that we use and the M&A comparables that we use have definitely been a headwind. And what we've gained on the swings, we've lost on the roundabouts. In our particular version of the portfolio, what we target, and again, HG is all about a very narrow tramline of what's done, has suffered from this, right? So the market more broadly has had the same impact across other private equity houses that do what we do. Then there's really 2 or 3 that do what we do globally. The broader industry hasn't had the same impact because their portfolio is broader. So if I look at other peer funds, even in the UK, the nature of what they invest in is broader, and typically their carrying values are lower and their multiples are lower because they're buying different kinds of assets. And that has meant that they've not had the headwind, and they might even have had a bit of a tailwind, and therefore they've had the benefit of the maths going in their favor. And for us, the maths has gone against us really in that aggregate. So I think we feel like model 100% intact, and if anything's getting stronger. Portfolio 55 assets, it's the same broad pattern of there's always a handful which are harder, they're having a harder time, they have more work to be done, etc. And there's equally always a handful that are really doing very well. That's the same. So that hasn't really shifted. So as I said, trading isn't really bothering us. It's been more the headwinds of multiple that we've been running into, and that's just held us back.
So I'm just looking at your portfolio. I mean, you have, I think, something like 60% of the values in the top 10 holdings. So you've got quite a long tail of smaller commitments in there. Do you ever look at that and say, is that the right balance? In other words, have we got too much concentration or too little concentration in terms of performance?
Yeah, well, the way that the portfolio is constructed, there's 3 fund families that sit within the portfolio, and there are 3 size brackets. And so the Mercury are smaller deals, quote unquote. Genesis is mid-size and Saturn is very large. And we've exposure to them all. So the decision has been to gain exposure to them all. What does tend to happen, and this is interesting, some of the biggest assets have been the biggest compounders. So despite the fact you would have thought perhaps that large means it can't scale as fast, actually they have scaled as fast, and Visma is the poster child, which scales faster now than it did when it was originally acquired 20 years ago, which is incredible. But that has an impact on the relative concentration. So if the initial holdings from the large fund platforms scale faster, then they become quite material. And obviously, if it's a smaller investment at the start, it's never going to catch that because it just can't ever catch up because of the relative starting points being so different. And that's what creates the spread. So I think what we are doing is we are thoughtful. It's not so much of a concentration problem, it's more of a fund management problem, I would say, or fund management challenge, which is the netting effect of these very large investments on the way in and the way out is pretty material. So if you think a big investment in the Saturn fund is probably 100 million sterling out the way, and a big return of capital is 200 million, 300 million sterling in the way. And we're running a cash flow model every month. So if these things move by a few months, it's big swings effectively. So what we're thinking through now, and we've got some plans on that, which will come out over the next month or two, is how we try and mitigate some of the effects of that to try and take out some of these big swing factor risks, which was more the issue. But that's the challenge. We don't worry about the shape of the portfolio. It's more the fund management that's relevant to the larger assets at the top, where we're just conscious of the impact they can have.
And this is something new that you've been developing, this approach, or has it always been there?
The problems are getting bigger because everything's getting bigger. So the size of the vehicles and the underlying investments and the size of the checks that get written to the underlying assets has continued to grow. And I think what's happened is because of the pattern of growth, we've ended up with bigger starting points. And as they've done so well, we could end up with quite a lot of exposure to certain assets. We try and mitigate that as much as we can. But I think what it's really going to come down to is a bit of a rebalancing across the different strategies that we invest in to try and make sure that we try and solve this problem or mitigate this problem to the extent that we can.
I'm just looking at your latest reporting and some of the research around that. I mean, one of the issues that comes out is the issue, I guess, of commitments versus available finance on your part. In other words, I think I read somewhere that you've got about 1.4 billion of commitments due to fall in the next 5 years. And against that, you've got about 430 million in cash, something like that. And you have a debt facility partly for that reason, to manage that mismatch if there is a mismatch. Doesn't that suggest that there might be a bit of a coming crunch at some point, or am I misinterpreting that?
Well, there's a big number, and board's very aware of the fact that it is a big number. If you think about her historical patterns, because we think about the outstanding commitments to the NAV as a ratio, and obviously as the company has grown, so is the NAV. So that ratio, if you look at its long-term history, it's not at the peak. It's actually quite a ways below the peak. But the thing that's a motive is such a big number. And the way that we think about it, we plan every board meeting, basically the first thing that comes up is the cash flow forecasts. So we're continually going, what are our outstanding commitments? Because again, the outstanding commitments are the commitments to the vehicles drive the future NAV of the company. So that is fundamental. But we need to understand the outstanding commitments, the commitment pipeline, because these things all have a pattern that we have to follow. What's the NAV in the portfolio? What's the NAV progression? And what's the liquidity forecasts that we have from that NAV progression? And HG are actually really, really good at telling the board what's likely to happen. And when we actually mark their homework against, did you do what you said you were going to do? And actually, they're very good at that. For example, they commit to their investors and their broader partnerships to send back the entire committed capital of a fund within 5 years. So they've hold themselves to that and deliver against that. And that's very helpful. So for us, we see the whole pattern of liquidity that's coming and the asset exposure. And obviously, we have the revolving credit line as a means to help manage the pattern. And what we are continually looking at is, have we got the balance right? So what are our outstanding commitments? What's the investment pipeline? What's the realization profile? What's the cash back? Where are we relative to the revolver? And does it all look good? And if it doesn't, then we have sort of a staircase model for how we solve these problems. And there's several steps on the staircase. So if we think we're going to hit a problem, we have at least 12 months to solve it because of the way the structures are created. And we have multiple tools to solve it with. For example, one thing we've done in the past is we have fund commitments inside the structure. That's what the main part of the asset exposure is. We can sell them. And we have done. So a couple of years ago, we sold a chunk of our exposure to what's called G8, Genesis 8 fund. We sold it at 100% of the net asset value. So no discount, just clean out of the value we held it in the books at. And that solved a potential liquidity problem. And that, interestingly, the liquidity problem didn't actually arise in the end, because the early warning radar picked it up 12 months out, and we felt prudently we should act because we did trip the radar, and we did, and we delivered it all. And then actually HG ended up with a bit like G Treasury, as I mentioned, accelerated liquidity that came out somewhat out of the blue. And at the end, we had no problem to solve, but it was the right process. So at one level, we can pull the trigger on secondary sales, and we have a bunch of time to do that with. The other thing is we've got 15% of the assets plus or minus in co-investments, and they're all individually realizable, so they're not in the fund structures. So if we want, we can dip into the co-invest vehicle and exit those individually bilaterally. So we have at least a couple of different levers. Firstly, the revolving credit line, secondary sales of fund positions, thirdly, co-investment, individual bilateral transactions. And then ultimately, if we really have a problem, we've got the opt-out clause that says that we can never be drawn if we don't have the available resources, which is basically unique to the company. No other LP in the world, as far as I've ever seen, has got one of these, but we do. So we have that ultimate nuclear option that's going to solve us ever getting into real trouble, but we hope we never get there. And the way the process is designed, that should never happen, but it's nice that it's there. So that's how it all comes together. And that's the front of mind, really, for managing this whole profile of investments. And that's what we use.
So that, as you say, is a clear differentiator for you. But would you be able to tell me and the other listeners today that the risk of having to trigger one or more of those kind of remedial steps is higher or lower than it was before?
There's nothing on the risk light system, traffic light system today We think we're comfortably within it. But it does move every month because HG re-underwrites their whole pattern of investment profile. Certainly every quarter, they re-underwrite it all. So their term is the realization committee. So realization committee meets every quarter and resets all the parameters, and things do move. And so one of the things that we have to make sure is that we've got enough flexibility. If they move rapidly, then we have to adjust for that accordingly. And we do. And you've seen in the past, the boards adjusted things around the levels of exposure to different vehicles and the relative exposures to different vehicles. Well, that's a live thing. So we do adjust these to the extent that things change. When the facts change, we change. But again, we wouldn't be doing our jobs if we let the radar run to red without taking action. So there's nothing to do right now.
You mentioned the co-investment policy and how you're increasing your co-investment. You have a target of 10 to 15%, and you're around 10%, I think, at the moment. If they're such a good deal, is there some limit to why you can't do more of them? They sound to be much more attractive than putting it into the funds. Now, obviously, I think you have to put them into the funds, otherwise your relationship with HG is compromised. But why 15%? Why not more?
The limiting factor is the way their deals are structured. Some of the co-invests that they do are enormous. So $400 million check to a single business, for example, and we couldn't ever do that because our balance sheet doesn't let us do it. So the way that we've set it up with them is to basically say, here's a framework agreement for co-invest, because we obviously, the board doesn't make these decisions on the individual assets, the manager does. But what we do is set the framework up and says, here's how we think about risk exposure across the different kinds of deals we could get in the different size brackets. And within those parameters, and again, that is all part of the cash flow model for how we have to run the company, we have a number that says this is the amount of co-investment flow we think we can create that matches up against this strategy. And the idea is to try and nudge it up. That is true. If you thought about a sovereign wealth fund, for example, their ratio of co-invest to primary is probably more like 30 to 40. And we're at 10. And I think we can easily get to 15, and we might be able to get a bit higher. But our own structural constraints will be a problem, even to the extent one of the rules in the SPA or the investment agreement for the company is a single asset concentration limit of 20%. So if Saturn does a really big deal as a fund commitment, then actually we would struggle to do a really big co-invest with it because we'd go through 20%. So that's another limiting factor on how big these things can be and how we would structure it. We're more likely to do more small ones than really big ones because we want to avoid that concentration risk problem that I just alluded to.
Just sort of flipping that on its head, what are the attractions to the other side of this equation? Why would HG want to give you more co-investment opportunities? Why would they be happy to do that? And could they not at some point, if the market improves, stop doing that?
Yeah, it's kind of table stakes now to offer these things. As I said, most institutional investors will want certainly 30, maybe 50% of their exposure. Because this is the thing, like people, again, don't really get this, but there's been a massive fee break in private markets, and this is where it's come from, right? It's the amount of capital that gets deployed now in the funds relative to how much gets deployed in these other vehicles is really quite different to what it was 10 years ago. So the big institutional investors are saying, we want to significantly defer the cost per euro, dollar, pound of our investment. And one of the ways we're going to do it is we're going to drive a lot through these co-invest programs, and that's going to bring our cost base down. So it's standard practice. And if you're out there raising capital in the broader world, if you're another manager, another GP, then you're going to find this everywhere. And so the key metric actually, because everybody fixates about fundraising, it's the wrong thing to look at. The thing that's important is not how much money you're raising, it's the price you're raising it at. It's not how many pounds you raise in your fund, it's the value per pound. And that's come down materially through the other means as well, actually, but co-invest is one of the major ones.
Okay, so that's an interesting longer-term trend. Let's just talk about the kind of businesses you invest in now. Software is obviously the sort of headline description of what HG invests in, and that market has been slowing. And there is this thing called AI coming up alongside, which we're all talking about now and studying. I've seen some people suggest that AI is a negative for the software business. Is that true in your estimation? But equally, are there some other structural things going on with the software businesses that might give you cause for concern?
Yeah, well, this is an area of obvious paranoia, again, for the board, because we're so exposed to it. So I would say there are clear implications for software around AI in lots of different areas. In fact, there's like almost too many to get your head around. I think what gives us comfort is HGR, I think, as on top of this as possible to be. So the way that they've set up and organized their partnership model, so they have partnerships with OpenAI, Cognition, which is behind the developer Devin. Anthropic. So there's a whole bunch of partnerships. They have their own internal group called Retina, which is there to drive AI adoption across the portfolio, to actually share ideas and leverage best practices. They have their own AI incubator, which is called Catalyst. So they're actually trying to disrupt themselves continually with their own incubated new business models. So from their perspective, the starting point is they buy market leading businesses. So the starting point is the market leading or the leadership positions of the assets is a good place to start from. The second is that these businesses are generally successful to the extent they can afford to invest a lot in AI, because that's the other thing. It's a bit of an arms race around how much you can invest in this stuff. Because of their structure and platform and scale and the profitability of the businesses, they've got the ability to invest. But then you need to know what to invest in. And that's where the leadership on the tools and the models of implementation and the amount of resource they put into this is all coming to bear. But again, nobody knows. So, like all businesses, there's a version of it which, we could be caught out by this, but we don't think that's the case. And I think where the board has spent a bunch of time on it. I mean, I personally spent a bunch of time on it. I've taken myself off to learn about it in the West Coast of the US. And we've all come back and gone, we think we're in the right place and we think we've got the right kind of portfolio. And the early emerging signs are actually more positive than negative. But it's a continual every time we meet what's happened and have we made sure that we're on the right side of it? Because there will clearly be some losers, but they'll be the ones that are in technology debt and they haven't perhaps evolved as much as they should have done, as fast as they should have done, or they're not able to, and they'll struggle. But hopefully we're not in that camp. We think we're on the other camp, which is the ones that will be net beneficiaries of it. And we see the early evidence of that coming through around different areas, like Salesforce effectiveness is an absolutely obvious win. We see that. We can put pound notes against that already. And the other one that's going to be very, very, very relevant is pricing metrics, because agentic AI is going to change the pricing models, certainly for cloud software, certainly in many places. And you're going to have to be on top of that to make sure that you don't get disrupted by that change of model. And I think they are. But we have to sort of continually watch that. That's 100% front of mind.
So that's the primary challenge, is the fact that to maintain your margins in a world where AI is doing a lot more things more efficiently and so on, and competition is potentially increasing because barriers to entry come down and so on. Is that the main transmission mechanism, or is it just the fact that you've got to get rid of a lot of people whose job is going to be done by AI instead?
I think you get a lot of uptick or upside from Salesforce effectiveness. So being able to cohort customers in different groups with more clarity, understand how to adjust what you sell to them on a value proposition to get more value to the customer faster. It's a speed game as well. So you definitely see these use cases very much in play. And of course, the other side of AI is how it impacts all the underlying activity of the companies that HG invest in, but then it's how it impacts HG itself. So there's a yield pickup in their own investment organization that they get from applying these tools. So they benefit from that. So we get both of it, I guess. And I think HG is pretty much at the leading edge of this. I mean, knowing a lot of other private equity firms, I think they're in the pack along with a few others who are at the front. But again, we don't know. So it's not a zero risk. But I think we're as well placed as we can be. And it should be a force for good. It should be a positive. Because, somebody said to me the other day, which was a good point, which is, for example, our biggest cluster is tax and accounting. You have to be 100% accurate in tax and accounting. In AI, it talks a good game, but it's not always right. And you can't really do that if you're dealing with the German tax authorities. It's not going to work. So again, there's things that it's able to do very well and things that it's not. And you have to remind yourself of that when you're thinking about the impact.
Yes, I mean, there's this interesting exercise to try and think about whether being a market leader and whether the incumbent sort of advantage you have is actually a positive or a negative. I think that's quite an interesting argument, which I'm sure will play out.
Yeah, I mean, I think they've done a great thing with this Catalysts team they set up, because the Catalysts team, the basic premise is go and disrupt yourself. Because the issue with disruptive technologies is you're often not the last disruptor. So you have to continually challenge yourself to think, well, how could someone destroy this and how would they do it? And let's make sure that we do it first so we don't get disrupted by it. But I think to set that up is a good indication of the way they think about it, which is, again, suitably paranoid around getting it wrong.
So just moving towards the end here, I wanted to ask you, if you're sitting here as a shareholder in HgCapital, and I should disclose that I am a shareholder in HgCapital Trust, what would you say to me when I say that obviously the market is changing and that's always happening, but there are some challenges specific to the private equity world, and there are some challenges specific to the kind of businesses that HG invests in. And looking back at your history, 20% compound over many, many years is an extraordinarily impressive record. What can you tell us about your confidence that you can repeat that?
So I would say lots of different things. I think private markets not going away. So it's probably as an industry, I would have said like 10 to 12% compounded growth is at the aggregate what it's going to do from about a $10 trillion base. So the private markets is still considerably smaller than BlackRock. So it's still, despite all the growth, relatively small. I would say the way it's developing is bifurcating into who's winning. And what's going to define winning is more or less going to be scale or specialism. So either be a very big platform or be very, very good at one thing. And obviously HG is very, very good at one thing. In the context of what they're doing, and obviously HG is the UK's biggest private equity firm now because of all the success that it's had. There's no reason why it can't keep growing and maintaining the levels of return. And we look at other peers in other places which are bigger and have done this for longer and maintained that level of growth. So I think there's no reason to believe the model's going to break. And one of the things that we look at fundamentally is the people in the process. So who are we really backing at HG to be able to drive this into the next decade? And are we comfortable they're thinking about this in the right way? They've got the right set of motivations. They're not taking their foot off the gas, which they could conceivably easily do at this point. But, are they doing that or not? Or actually, do they have the same hunger, desire to just continue to deliver what they've been delivering and have the model for it and the capability for it? And yeah, they do. And so, HG is in a very unique club of, say, 10 firms around the world, I would say. And we're just really lucky in the UK that there happens to be a public vehicle because there's no other vehicle. None of the rest have got anything that looks anything like this. But we've got that for reasons of funky history, but we've got it. And so great. Well done us. But I don't see any reason why. I mean, private equity is definitely not going away. And the HG model within it is as well placed as it could be to continue to deliver what it's been delivering. The baseline assumption from the board, when we do our strategy work, is that that's what will happen. That's how we've organized it.
So even though we know from history that the average life cycle of successful businesses is about 25, 30 years, you've just clocked up 30 years. You think you can do another 20 of the same pace? That's quite a big call.
Well, 3i was 1947 and it's doing all right. So I think the thinking that goes into how they operate and how they organize, I don't think it's going to stop anytime soon. I've seen hundreds of firms fail or lose their performance upside over time in my career. This isn't one I worry about. There's lots of others I worry about first.
So the biggest risks that you see, therefore, are external to HG, if you like. They're what happens to the global economy, what happens to things like interest rates and so on over the longer term. Those are the bigger risks you face. I mean, we haven't talked about one other, which you do highlight all the time, which is cyber security. Yeah. That's a massive issue for you, I think, or if you like, another elephant in the room that hopefully won't materialize.
Right at the top of the risk register. So as we were speaking, it's HG's annual meeting tomorrow, actually, and it will be front and center for that. But I think on the cyber, I mean, again, it's a never ending struggle. And all you can do is have the best structures and processes to mitigate the risks to the extent that you can. You cannot avoid it. It's a question of mitigating as much as possible. And indeed, sandboxing as much as you can, because you're going to get attacked all the time. There's lots of scary stories I could tell you about how little we know about how much we've been attacked, because clearly if people attack you, they don't necessarily leave a calling card saying, hello, we have been here. But the amount of attacks that are out there would sort of blow your mind. But I think for us, the idea is we just need to make sure that we can mitigate any existential risk, which means anything that is attacked has to be sandboxed. And we continually have to push the boundaries on how well we're dealing with these things. And they actually cyber score all the portfolio, and they cyber score it on the way in. And there's a minimum acceptable level of performance that the businesses have to, if they're not at it, they have to get to it within a 12-month period. And that's a risk register point. So if there's any that are not making that level, then it's a risk register. How do we solve this? And it goes into a red alert until it's actually solved. And I think that's really kind of as much as we can do around it.
It has been striking how Jaguar Land Rover or M&S and so on, I mean, it's becoming visible anyway. It may only be the tip of the iceberg, but at least we are seeing the tip itself and seeing what consequences it can have. So it's obviously a serious problem. Anyway, I don't want to end on a depressing note, but that's one of the risks to worry about, I guess, if you're in any kind of business. So I'd like to thank you, Jim, for your time this time on the podcast and giving us such honest and helpful answers on a wide range of issues. So thank you very much.
Absolute pleasure. Thank you again.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.